This is a video on the producer's decision. In other words, profit and costs. This video in this section contain a whole lot of definitions, and it's kind of difficult to reduce 2 lectures, 2 hours worth of material down to a 10-minute video. So if you have any questions or want some additional information, feel free to reach out. Or again, there's stuff on YouTube, longer videos with more production value that I can recommend. My general advice for this section is just to try to think very carefully about what the definitions are saying, what the terms are trying to tell you, because without having to calculate anything or know too much about the definitions, the names of these types of costs and these definitions often tell you a little bit about what you need to remember about them. Okay, so first of all, we want to think about the producer's decision and the decision making. And so we can call a producer of goods and services by a few different names. In the textbook, they often take the name of firm. And so here we're not talking specifically about like a law firm. This is just any producer or supplier. I might use the terms firm or producer or supplier kind of interchangeably for the purposes of this class. They all mean about the same thing. You've got your supply curve that we introduced a couple of chapters ago, and that is composed of individuals or institutions that produce goods and services. All right, so all firms have to decide what goods and services to produce and how to produce those goods and services. That's just kind of the basic idea. And then the goal of any business, in our theory, now in reality, there might be nonprofits and other types of businesses, but in general, we're assuming that the goal of a business is to maximize profit. And profit has a very specific definition, which you need to know, which is profit equals total revenues minus total costs, or in equation format, profit equals our total revenue, which is price times quantity, minus our total costs. So in this unit, we're going to be talking about total costs. We talked a little bit before about market equilibrium and what happens to prices and quantities if we get shifts in the market. Now here, we're going to be talking specifically about the structure of cost curves. And again, it's a lot of definitions in this chapter, but these definitions are going to be the same for all of the future chapters. And so no matter in, like on midterm 3, when we're talking about different types of market structures, perfect competitors, monopolists, everything in between, all of the statements that we're making about costs are going to carry over. So you only have to learn this stuff once, although, again, you need to kind of pay attention to these definitions. Okay, so profit, total revenue minus total costs. Total revenue is price times quantity sold minus our total costs. We're here to kind of define what total costs are. All right, so total costs could be broken down into ones that are actually paid explicit costs or ones that are opportunity costs that you don't actually pay. So the basic idea behind this is, why might a store go out of business even if it's earning a positive accounting profit? Or in other words, if they only have these explicit costs and they're making more revenues than their explicit costs, why might a business shut down? Well, there could be opportunity costs. The business owner wants to do something else, or they don't want to be in business. They could make more profit doing something else. So these are the implicit costs. And again, a producer decision maker is going to take into account for sure the explicit costs that they're paying, but they'll also take into account what they could alternatively be doing with their time. Okay, so I will make a separate video entirely about short run versus long run calculation, because that's stuff that we're going to need to know going forward. So I'll kind of skip over that for now. But I will say that we assume for most of this class that we're in the short run, where we have what's called fixed costs. And fixed costs are costs that do not change in the short run. All right, so we'll talk a little bit more about fixed costs and types of costs. I think I'll make a separate video, one on short versus long run, one video where we do costs and cost calculations based on the tables that they like to give you as homework or quiz problems. So here, what we're assuming about costs is that we have some fixed costs in the short run, and then we also have variable costs, which increase as you produce more stuff. Right, so if you have a farm, you have a fixed farm size in the short run, and then you want to figure out what to plant. You might need to hire some workers, you might need fertilizer, pest repellents, things like that. And the more you plant, the more of the variable inputs you'll need. And so your total cost is going to be the fixed cost plus the variable costs. All right, we also talk about fixed costs as being sunk. And so, basically you've already paid for your farm. You're on the lease for however long. So you're paying that no matter what. And this is kind of looking ahead to the next chapter where we're talking more about the profit decision. But the general idea here is that when we're thinking about what the producer's decision making is going to be, we as economists generally think that the producer will look at their marginal costs versus their marginal revenues. In other words, they'll look at, if I produce and sell one more unit, how much additional will that cost me versus how much additional revenue I will bring in, right? So this decision is independent of the sunk or fixed costs that they have already paid. We're just asking, if the producer produces one more, what will happen? So this is the idea of thinking on the margin. And so these marginal costs and marginal revenues are going to be the key to our economic analysis going forward. All right, so talking about costs again, I will come back and do another video where we talk about these costs and then we derive some from the table. But I just want to reinforce the two types of costs and ultimately some revenues that we'll be looking at moving forward, which is marginal versus average. Let's just start with the average because that's a little bit easy. Everybody, at least hopefully everybody, has already seen an average before. So if we want to take the average of anything, we just divide by quantity. So in other words, all of these average costs are just the cost that it says it is divided by quantity. We want average fixed cost. We take whatever the fixed cost is, we divide by quantity. Same for variable or total cost. All right, so for marginal cost, then we're thinking about the change. If we produce one more unit, how much additional cost will that be? So in mathematics, we have the change in total cost divided by the change in quantity, but more simply, you can just think about it as, if I produce one more unit, how much additional will that cost me? All right, so here's a good problem that kind of shows marginal versus average. We've got this Sunil's bookkeeping service can prepare 34 tax returns in a week with 4 workers. With 5 workers, they can produce 41 tax returns. So what's the average product with 4 workers? Well, it says with 4 workers, they can produce 34 tax returns. So what's the average? It would be 34 divided by the 4 workers. And what's the marginal product of the 5th worker? That's asking, if they hire one more worker, how many additional tax returns can they prepare? So the marginal product here, they go from 34 to 41, an additional 7. All right, so again, just keep in mind what a marginal is and what an average is. Then hopefully you can easily come up with that in a test environment. All right, going to come back here and we'll do this table and talk about that. I just wanted to talk a little bit more about sort of the shape of cost curves, a mathematical rule. You won't be tested on it, but what do cost curves look like? Again, this is going to be assumed throughout the course of the class. We've got a marginal cost curve. As we produce more stuff, it costs more. All right, this is a result of the fact that we have this kind of like decreasing productivity of labor. Sometimes the book or the text gives an example, like you've got a factory of a fixed size, and as you hire more and more workers, for a little while, they can become more productive. But if you hire too many workers, they'll just kind of get in each other's way. So at some point, the marginal costs of producing more, a higher quantity, are going up. All right, as a result of that, Average total cost and average variable cost are these sort of U shapes where first the averages are decreasing, but eventually the marginal or the next cost, the cost of producing one more, is high enough that these averages will start going back up. All right, so again, I don't tend to test too much on the shapes of cost curves. If you were to move on to like an intermediate microeconomics class, kind of the deriving these curves and the shape becomes more of a focus. So if you are an econ major or looking ahead, feel free to ask more questions about that. For now, just kind of understand maybe where to find this picture in the notes. If the homework quizzes ask questions about kind of the shapes of these curves, you can sort of use this picture for reference. All right, so I think I'll end that video here, and then again, I'll make some separate videos, one on kind of calculating, and then one on the short run versus the long run, which is important moving forward.